My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour is Brad Freeman, the stock market nerd himself. I remember a time, Brad, when being a nerd was a bad thing. And suddenly it's now become the right way to look at life. So introduce yourself, Brad, to the audience. Who are you? What's your background? As you get involved, interested in markets? And what are you doing currently?
Yeah, thanks for having me. And yeah, to me, nerd is just another way of saying passionate about something. So extremely passionate about stocks and investing in businesses. I've been pretty much my entire life. I've had great role models growing up. I'm 26 years old, just for context. My dad had me learning PE ratios and what revenue meant before I could divide and multiply. That's actually how I learned how to divide and multiply, by looking at PE ratios and other valuation ratios. But kind of zooming ahead, I graduated from the University of Michigan in 2019, immediately started a master's in finance program at the University of Michigan in 2020, finished that about 18 months ago, I think. I've worked at a registered investment advisor for about a year, a small shop called Diversified Portfolios in Metro Detroit, where I am based for 6 months a year, and then Fort Lauderdale for the other 6 months. Remote work I fully take advantage of as a 26-year-old snowbird, and I like to eat dinner at 4:30 p.m. and knit in my free time and all of those wonderful things. But yeah, I wrote for the Motley Fool for a little while, stopped writing for the Motley Fool in I think 2022. Just there was a lot of interest on Twitter and me kind of branching out and writing my own content. So I started doing that. I write a newsletter that covers popular companies and my holdings and macro. And yeah, that it's stock market nerd means stock market, very passionate to me. And yeah, I'm grateful to be able to do what I love to do. Yeah, that's me.
What did your father do career-wise? I mean, if he had an influence on you on the investing side, was he doing it because that's part of his profession or just because he loved investing?
Yeah, so he's had sort of a two-part career. So he started out at a fund as an analyst at a fund before we had Capital IQ and all those wonderful things, and had to mine data manually, which he's told me horror stories about. But he now actually runs a dry mixed food manufacturing company in Detroit, not super related at all to the investing world, but he's always been in that frame of mind and has conditioned me and my two brothers to very much so think in that opportunistic risk reward frame of mind.
And is that mindset primarily more along the lines of fundamental analysis or technicals as well?
Yeah, my background is very much so in fundamental analysis. So just very, very much so tracking demand and margin preservation and market share and prospects versus risks and again, risk reward, and just seeking out, I guess, just the most compelling opportunities at the most compelling price with the highest conviction. And I know that's a very cookie cutter answer, but really from the overarching 30,000 foot view, that really is where my mind is focused. I don't pay very much attention to charts, but I do find that when fundamentals are flawless and valuations are attractive and markets are cooperating, technicals and fundamental health do kind of sync up pretty commonly. I look at it from a fundamental perspective. A lot of brilliant people look at it from a technical perspective. Just, I think, two different points of view for doing things effectively in both cases, potentially effectively.
So what you're saying is you are all in on NVIDIA. That's what I'm hearing on your give the fundamental focus. I'm joking, of course.
Yeah. In NVIDIA, I know there's probably a lot of people in here who are passionate about the company, so I will refrain from giving the valuation commentary, but I will just say that no, it is not in the portfolio currently.
Okay. One of the criticisms around fundamental analysis, which I think is largely true, is that, it lags the technicals, right? So the technicals tend to move first, then the fundamentals follow. That's only true up to a point because technicals obviously can result in, overreactions on the upside and downside for people that are following different indicators. How do you think about the lead and lag, pun intended, relative to my username, but sort of the lead and lag dynamics of stock price and fundamentals? Because yes, there is an argument that markets are largely efficient and should be pricing in what the fundamentals tell you.
Yeah, and I think I'm with you in that markets are rarely efficient, or maybe kind of like broken clock is right twice a day at type efficient. But to me, it's that inefficiency that's so compelling about markets, and that old saying of babies being thrown out in the bathwater, and using the cliche Warren Buffett quote of greedy when fearful and fearful when greedy. But it's really, for me, it's fixating on fundamental health. So tracking how the fundamental bull case is developing and evolving versus all the risks that are inherently present. And then using things like 2022, where just everything is being sold off indiscriminately. Doesn't matter how well you're performing. Doesn't matter what your price tag is. If you're labeled a growth company and have revenue growth in excess of GDP, you are being sold off. But while that sounds frustrating, that's really what creates the recipe and the opportunity for alpha. So it's kind of leaning in almost when when technicals do look a bit fragile and when maybe some TA people would be leaning away, and just taking advantage of the fact that I have this multi-year time horizon and I can wait for charts to look a little more friendly and I can wait for sentiment to turn a little bit more. And I know that charts and sentiment probably are going to turn as long as revenue's compounding at a brisk clip, as long as there's operating leverage in the model, as long as their market share position isn't deteriorating, as long as they're effectively expanding into new adjacencies for revenue growth and have a lengthy runway. It's almost selfishly using broken technicals when they're combined with pristine fundamentals and a compelling valuation, and selfishly using that to my advantage. Yeah.
Yeah, and I do think it's correct me if I'm wrong on this, but fundamentals really help you to have confidence in a aggressively declining market, because if you're talking fundamentals, you're talking about long-term prospects, not short-term dislocations.
Couldn't agree more.
Okay, so let's talk about the last 3-4 years. Obviously, your experience on the career side, and obviously your studying has happened in a pretty wild period where a lot of cycles got compressed post-COVID. Have you been finding it easier or harder to find good fundamental plays given what's happened this year?
Yeah, I think several months ago it felt easy, but I guess that's probably using a little bit of hindsight bias, just because things have worked out over the last few months. So now I guess looking back, it feels easy. But I mean, with companies like leaning into Uber in the high 20s and PayPal in the high 50s and Match Group around 30 and things like that, there were just these excellent businesses just compounding revenue as far as the eye could see at 10, 15, 20% clips, and trading at PEG ratios with phenomenal asset bases and really iconic brands, trading at PEG ratios well under 1x. So PEG ratio meaning, and I know you know this, but in case somebody else doesn't, price to earnings divided by earnings growth. Do love to use multi-year CAGRs for earnings growth just to kind of smoothen out the lumpiness and noise of earnings growth in a lot of models. But it has gotten very fun very quickly. So over the last, I guess, several weeks or a few months, just aggressive multiple expansion to a point where, as aggressively as I was leaning into some names in late 2021 and early 2022 and throughout most of 2022, I've since kind of pivoted into trim mode and not. I mean, I'll always be predominantly invested. I'm a long-term investor. I have a bullish bias, very slight bullish bias, but it's there. But I do trim, and I'm not a just buy and forget. When Shopify it races from $30 to $70 a share and is trading at triple the gross profit multiple of the S&P 500, yes, I will trim some. When the trade desk trades at a PEG ratio over 3x, which anything above 1.5x is starting to get a little pricey, I do trim a little bit. And those kind of scenarios have been popping up very recently with all this aggressive price action. Have pivoted from accumulate to gradual trimming and building the cash position. And for me, that means cash pile grows by a few percent. It's really gradual, but it is an important part of risk management for me.
All right, since you mentioned Shopify, I feel like we should talk about fundamentals maybe by sector, right? So PEG ratio is obviously great for tech names, right? PE, price to book, probably more for kind of more hard asset type of companies. Do you look at different sectors and say to yourself, you know what, this ratio is more important for this sector versus that sector? Because I don't know if the marketplace puts the same emphasis on different valuation ratios based on just the way certain sectors and industries move.
Yeah, it's a great point. And I think it's sector by sector for sure. It's almost company by company in some cases. So I'll give sort of an example of both of those. So sector by sector, I mean, I love using free cash flow multiples. And I am in the camp that, well, we could talk about stock-based compensation later if you want to, but just for now, I do love free cash flow multiples. But I mean, when you're looking at the banking sector or a retailer that's really aggressively trying to liquidate inventory, free cash flow can become a very noisy metric. If I'm adding loans to the balance sheet to harvest more net interest income, that technically under GAAP accounting counts as cash burn. If I am liquidating inventory like a company, I'll use maybe a company like Revolve for my portfolio, like every other next-gen fashion company got ahead of itself with inventory positioning. Now it's liquidating that inventory. So free cash flow looks amazing because there's just cash flowing in the door. But it's kind of a noisy metric and it's not going to sustain. It's not going to be durable because once that inventory has been liquidated, free cash flow will look a lot more similar to what it has over the last 20 years for the company. But that's one thing. And then another weird GAAP accounting rule that I kind of guard against when I'm valuing companies is under GAAP net income, it's things like mark-to-market equity valuation gains or losses. I'm thinking of companies like Amazon with a Rivian stake, or Shopify is another great example with Global E and Affirm. those equity stakes have just been so violently fluctuating in terms of valuation. And as they violently fluctuate, they're quarterly marked based on their valuation. And that counts as, if Rivian went up 50% during the quarter, that counts as more net income. And if it went down 50% during the quarter, less net income. And in reality, that has zero bearing on the overall operating profitability of the company, and how profitable it is and how profitable it can be. GAAP accounting rules are weird. They work really well sometimes, and they don't work all that well other times. But those are two important points. And then for the other point that I want to make, and sorry if I'm rambling a bit too much, but for growth stocks that are not optimized for net income, that are pouring every single potential profit dollar back into more revenue growth and back into more demand and back into hopefully more operating leverage down the line as economies of scale build, I don't really like to use earnings multiples, because I mean, again, Shopify is another perfect example here. They're earning near 0 cents. Okay, you wanna say the PE is 3,000, that makes it sound ridiculous. But if you look at EBIT or if you look at gross profit, it looks a little bit more reasonable, not in Shopify's case, but in a lot of cases. So just using valuation denominators that companies are optimizing for, knowing the weird GAAP accounting rules that make free cash flow noisy, that sometimes can make GAAP net income pretty noisy. And then, yeah, I think that's a good place to leave, so I don't talk your ear off for 30 minutes. But
no, that's good. No, but I want you to keep riff on that, because I think why I give you a lot of credit, because you're certainly not talking like a lot of the FinTwit people that are around your age that are just mooning in option 0DTE type trading. You're talking about actual dynamics in terms of what drives a company more than just gamma squeezes. But this is where I think it gets to be nuanced and challenging, because everything you're talking about, anybody that's listening to this is probably thinking to themselves, wow, this is pretty deep in terms of looking at what's going on with a company, which means they need to have an accounting degree, right? Which is obviously not the case. How much of that kind of work that you're doing is attainable in terms of people understanding if they don't actually have kind of more accounting type of mindset?
Such a good question. And thank you for that question, because it gives me a great opportunity to kind of point people to free resources that now exist online, and also to plug the University of Michigan and Go Blue, best school in the world. And I went there. So obviously I think that, but I digress. It is complex. And there are a set of static rules that you sort of need to learn if you want to stock pick. And if you don't want to stock pick, and if you want to put your money in an index fund and forget about it, that's a perfectly viable strategy as well. But if you want to dive into the world of single stock investing, you do need sort of an accounting 101 base of knowledge and a financial valuation base of knowledge. And I mean, I got a degree, and you don't really need to get a degree, because you go on sites like edX, and the University of Michigan has world-renowned professors who are teaching you financial accounting and financial valuation at your pace, on demand, from your couch, for free. So the barrier to learning, that's really my favorite thing about the internet. The barrier to gaining knowledge and to absorbing knowledge and bettering ourselves is just a Google search away, or a Bard search away, I guess now, or ChatGPT, or whatever you use, but probably still Google search for most people. But it's all there. It's all free. And I think it is a bit tedious to learn, but once you know it, what I'm saying is going to sound like second nature, and it's going to sound like arithmetic for you, because it is just memorizing rules and memorizing nuance and noticing the patterns that constantly pop up in terms of those rules and examples of them.
Yeah, I mean, I think the barrier is the same barrier that's as old as time, which is just the mental barrier of having to put the effort in. Right? I mean, it's a lot easier to look at a chart than to look at a balance sheet.
For sure, especially a bank balance sheet, man. Those are an adventure.
So that's an interesting direction to go. To your point, let's maybe take a step back from that. What types of companies tend to be hardest to evaluate fundamentally, right? So you just alluded to banks. I'm sure there's more than that. But talk about sort of where it's easier to get a handle versus not easier to get a handle on what's going on with the company.
Yeah. And I almost, this sounds a bit counterintuitive, but I seek out difficulty, because if it's easy, if it's an incredibly easy story, then there's probably countless other people who've already thought of it and are already putting it into practice, and maybe that alpha has already been eroded away. But for me, and I'll use example of Airbnb in 2021 and now Uber in 2023. But it's these companies that are, and Meta is another great example too. But it's these companies that are kind of refocusing their leadership philosophy and how they think about their business model and how bloated they need to be. And the COVID pandemic has been an incredible example for so many companies just overhiring and it just irrationally building out their fixed cost base and now right sizing it. But the flip side of that right sizing is obviously unfortunate layoffs, which suck, and it's kind of a necessary evil right now. Reduction in real estate footprints and impairment charges and all of those things. But it really leaves you with these gigantic revenue bases in the cases of Airbnb and Uber and Meta, with where even a few basis points of margin expansion, even a few basis points of operating leverage can have a really needle moving impact on overall EBIT. And the thing about sell side analysts, not trying to sound arrogant or anything, because I think most of them do a great job and they provide a really important service. But their estimates, their estimates and how they track and how they evolve are usually not super current, are usually not super real time. So to me, when there's these massive transformations happening at Airbnb where, okay, we're going to turn off performance marketing and see what happens. And okay, we still have all of the demand we had when we were spending on performance marketing, but now this cost bucket went to zero. Or for a company like Uber, okay, we're going to exit Italy. We're going to rationalize the product suite. We're gonna fire a lot of people, unfortunately, and we're still not going to have any market share deterioration or any demand erosion at all whatsoever. And when that happens is when you really can start to see these 15 to 20% growers deliver 50, 60, 70, 80% EBIT compounding for several years, which is what Airbnb has done and what Uber is expected to do over time. And there are incremental cost cuts, there are incremental layers of efficiency being built into these models right now that I don't think are being accounted for in real time based on estimates. And I think that is, and obviously I could always be wrong. I've been wrong before and I'll definitely inevitably be wrong again. But I do not think that estimates in this case have come even remotely close to catching up to what these businesses are currently doing and how they're positioning themselves for future success. Now, Airbnb is kind of a backward looking example. Uber would be an example that's kind of coming to fruition right now. Another one might be Amazon with things like the localization of their fulfillment footprint. They've been running a lot of parallel redundant assets in their infrastructure in terms of fulfillment across the United States and North America for a long time. And now they're getting away from that while they layer on third-party selling, while they layer on advertising, while they layer on more cost cuts. It's business evolution. It's business model evolution that I think takes time for analysts to understand. And if I'm obsessively tracking every single news release and data point that I can get my hands on, I found that I can kind of identify that for maybe a bit quicker than others can. And again, sometimes we'll be wrong.
Okay. And I think that's actually another interesting point. If you're going to have the mindset of fundamental analysis and being a long-term investor, you can keep on getting news releases and information on your existing holding, but presumably you're not necessarily doing too many changes, right? Unless something dramatically happens on the fundamental side. What makes you tell something that you had a pretty firm belief in from a long-term perspective?
Yeah. And I'll split that into two kind of buckets and two mindsets, but in the mindsets would be trimming versus liquidating and exiting. So trimming for me is intimately connected and based on multiple expansions. The Trade Desk and Shopify are the two positions that I've been trimming recently. It's because of just aggressive multiple expansion and somewhat egregious forward multiples. But at the same time, when companies look ahead of their skis short term, but there are still miles long runways to enjoy, and there's still phenomenal companies with a decade plus track record of consistent revenue and profit compounding with operating leverage and all those wonderful things I look for. I'm willing to hold a somewhat expensive stock, maybe even too expensive, which I think both of them are right now, and just trim around the edges and take some profits, but keep the core position intact, knowing that it's if they continue doing what I think they're going to do, that they won't be expensive forever. But that last point is extremely important, doing what I think they're going to do. And that's a really good segue into exiting and liquidating decisions. For me, I mean, Microsoft had their Windows 8 drama. Netflix had their phasing out of physical DVD drama. And then the point is the best companies in the world all have hiccups, and success is never linear and it's never without bumps. And so along those lines, good reasons to exit a position would be sharply slowing revenue growth or sharply deteriorating margins or sharply falling market share over a string of several quarters. That last point is important. If they mess up for a 3-month period, I'm generally, I do like to be a bit more patient than that. If it's bad enough, maybe I'll just stop adding and put it on maybe like a hot seat if you want to use a sports analogy. But it would have to be multiple quarters in a row of just really disappointing demand or really worrisome margin evolution, or things like egregious stock-based compensation and maligned leadership compensation incentives. The C-suite may be serving as a revolving door of entrance and exits, just a hint at poor culture. things like that. But it's not, exiting decisions for me are not based on things like, well, this person was elected president and I wanted this person to be elected president instead. So now I have to sell. Or things like a new competitor just entered this gigantic fragmented market. Oh boy, they're going to take 100% of it and I need to sell. Or a sell side analyst just downgraded the name, or a stock sold off after an excellent earnings report because maybe it's a Shopify and trade desk and got ahead of itself short term. So there are good reasons in my mind to sell when they're not taking care of the things that are in their control, when they're not executing against the things that they have a say in executing against. And then there are bad reasons where there are just exogenous features that are messing with results on a temporary basis and really won't have any bearing on their long-term value creation for shareholders.
Okay, let's talk about mastering earnings, the name of the space. And full disclosure, I now use AI to create the titles for these spaces based on the back and forth I do on DM. As much as I criticize the narratives around AI, clearly it's useful, but still requires some human oversight. Where are we in the earnings cycle here? Anything that you're looking for that maybe the media isn't paying too much attention to? And I guess the bigger question is it going to matter? Because FOMO seems pretty damn powerful now.
Yeah, where are we in the earnings cycle? Tesla and Netflix were really the bellwethers last week. I guess you can throw JP Morgan and Bank of America in there, who both had pretty positive, upbeat things to say about the American consumer. American Express also did. Now they have a very, very affluent customer base. So that's a little less important than a JP Morgan or a Bank of America, because it's less of a, it's not as valuable to extrapolate that for the entire population. But for Bank of America and JP Morgan, it is more. But I guess looking ahead this week, today is going to be a marathon day. 4:00. We have companies called Microsoft and called Alphabet and Visa all reporting earnings after the bell. In terms of kind of what I'm looking for all three, I don't own any of the three positions, but I do track them, all three of them, very closely, just because they're bellwethers and great hints at how other companies are going to perform. But for a company like Microsoft, I am excited to hear what they're going to say about this Copilot 365 product. Did some fun math on this, where just a 10% conversion of current 365 subscriptions, they've got over 300 million seats, but just call it 300 million. Just a 10% conversion for this gigantic, just mammoth company would mean a 5% boost to its overall 2023 revenue. Now, so I said 10% conversion. I've seen some people say 20. I've seen some people say 50. So just kind of let your mind take you where that goes in terms of moving the needle for Microsoft, which is just, it's hard to wrap your arms around how many levers of growth that this company has to pull at just hundreds of billions of dollars in revenue. That'll be interesting in terms of Google and Microsoft. Any commentary we have on Google search market share and how Bing is doing, I'm sure they're both going to say they're doing great because they have an incentive to talk up their books inherently. But in terms of Alphabet, what I'm looking for is just more operating leverage at Google Cloud. So last quarter was its first quarter ever of turning a positive EBIT margin at Google Cloud for that segment. There was a bit of change in cost realization and where they were allocating costs, which helped a little bit. But if you strip that out, the margin was still pretty much break even, and they had a ton of operating leverage year over year. So that has been a massive drag on their overall results, just because they've been investing so aggressively ahead of the situation. I used air quotes there because that's what leadership always tells us. They're investing ahead of demand and ahead of expected customers. And now those expected customers and the expected demand are actually coming. So this profit drag is going to turn into a profit tailwind, which could be pretty exciting for Alphabet shareholders. And then you include that at the very end of last quarter, heading into this quarter, they told us that the ad market for YouTube was kind of bottoming, showing green shoots. So that should be important for them. So those two are, it's incredibly important results for the overall market for people who have any kind of maybe not several year time horizon like I do, who are looking at things more on a week to week basis, will be extremely important. And then Visa and MasterCard both this week. I talked about Bank of America and JP Morgan as great consumer bellwethers. These two are probably arguably the best bellwethers for consumer spend data. They represent trillions and trillions of volume together. They represent a large chunk of consumers in the United States and across the globe. And they give us a great sense in their spending pulse reports and their quarterly earnings reports of how the consumer's feeling, which is really important for pretty much every single other company that operates in the United States and isn't completely recession-proof or completely immune to the ebbs and flows of economic cycles, like maybe a tobacco company or something. So just really important earnings today. Tomorrow we have Meta I think Chipotle reports, and then ServiceNow also, MasterCard later in the week. Just a really impactful market week for earnings. I'm excited to dig into all of it. The data is, for me, for the nerd, the stock market nerd that I am, is very fun to digest. Looking forward to about 5.5 hours from now when I get to digest. Yeah, so expecting versus capitalizing, I think in you feel free to disagree with me, but I think it just is very much so based on the length of the expected project, or so maybe for a data center investment, if Meta wants to just completely overhaul its data center footprint like it's doing with AI workloads, that to me, capitalizing that makes more sense than just having that flow down the income statement on a quarterly basis. But if maybe I'm hiring 10 people to go sell this new infrastructure and this new footprint to new customers and have them ramp up their usage of these workloads, that would be SG&A and operating expense, which should flow down the income statement quarterly. Sure. And I think you have to ask the accounting officers of both of those companies why they treat very similar cost buckets very similarly. But that again goes back to just the nuance of GAAP accounting. And I mean, even within like things like input cost classification and gross profit, you can have 3 different CEOs at 3 very similar companies with 3 very similar cost classifications, and one call this an input cost and one call that an operating cost, and have gross margins look much different. But in terms of and you're asking about banks, so this is a bit more complicated, but it is really looking at the cash flow statement and the income statement to make sure there's not gigantic discrepancies in how they're allocating costs. Because I mean, well, that would be an issue where I would maybe lean away from investing in those names and investing in those stories unless I completely understood why they're making the decisions that they're making and why it makes sense, which in this case, just based on your State Street example, which I don't follow all that closely, I couldn't give you an intelligent answer for why they're specifically doing that.
But I think that goes back to the earlier point about where do you focus the fundamental analysis, right? I mean, if you're talking about companies where there can be those types of different treatments, yeah, there might be some bigger upside if you can untangle and normalize things. But I guess the bigger question is, why do that when there are other companies that could still be cheap and you can have a better handle on?
Yeah, and I think so. I'm going to answer this in a certain way, and if I didn't answer the question the way you wanted me to, please ask it again, and I can answer it again. But I think this is just an important argument for one valuation metric not being the end all be all prize of valuing companies, and how different business models with different nuance and different cost classifications definitely need to look at a free cash flow multiple, and definitely need to look at maybe a contribution profit multiple or a book value multiple in the case of banks, or net income multiple, just to really round out the story and to make sure that they're all, to use a maybe not a super professional word, all jiving and meshing together, and to ensure that there's not maybe unscrupulous accounting activity going on, and that it truly is just how they think it is best to account for certain cost classifications. Like price to contribution profit, like you would with price to earnings or price to EBIT or price to free cash flow. Yeah, just another slice and another way of looking at profitability, and an extremely important one for maybe a company like for marketplaces that have variable expenses and fixed expenses that are very neatly tied into 2 buckets, and just eliminating one to see a view of profitability in that light, and then eliminating another to see net income. And yeah.
You had mentioned earlier stock-based compensation as something that you look at or consider. Maybe outline a little bit of that, Brad. I'm going to make the assumption that this is ultimately all about alignment, but maybe there's more nuance to that.
So accounting for free or stock comp and free cash flow.
Yeah, no, we'll just talk. Sure. Yeah, stock-based compensation. You mentioned earlier that that's something you'd like to look at as part of the deep dive into.
Sure, yeah. So I think the debate on Twitter is, or maybe everywhere, but I live on Twitter, so on Twitter it's definitely
there is no debating on Twitter. People do not debate; they just each other nonstop. It's almost impossible to have any kind of like actual discourse with tweets on Twitter anymore. But that's a different discussion.
Okay, so the bickering on Twitter, maybe that's the better word, is that so should free cash flow be treated as a cash expense or a dilution expense? And it is not a cash expense. It should not be treated as a cash expense. And I know some people probably hear that and they see red and they're saying, well, you're diluting shareholders and you're eroding profits, so it has to be treated as an expense. And to that, I say you are 100% right. It's just treating it as the expense that it actually is. When you're selling, or when you're gifting or granting shares to your employees, and they're selling those shares when they're finally allowed to on markets and collecting money, there's not cash going out the door on your balance sheet. Like you're not paying them for those shares. What you are paying for is that your valuation multiple. So the overall share count is diluting the value that profit growth and profit compounding should be delivering to shareholders. So price per share is, if there's 1 million shares instead of 500,000 shares, that's definitely got to be taken into account and taken into the calculus. For me specifically, it's not foregoing the add backs on the free cash flow statement, because we have that view, that what that's trying to accomplish. We have that view of profitability on the income statement, but it's tracking free cash flow per share with the add back, so that we can penalize companies for diluting shareholders and for growing the share count and for giving me less voting power and less say over the future potential of the company, instead of treating it like a cash expense. And especially because for things like PSUs, they're granted, when they're granted at strike prices where if they never hit, if those strike prices never come to fruition, you don't get to take those stock comp dollars back under GAAP accounting. They are still expensed as stock comp dollars, but never actually turn into shares and never actually dilute shareholders, which is just another reason why I really truly believe it should be treated as dilution instead of fudging with the free cash flow statement to eliminate it. Now, I do know a lot of people disagree with me on this, which is why I give both views when I put together numbers, but I just do one over the other.
How important is earnings surprises to your way of looking at companies? You may be familiar with this, but there's a well-known phenomenon called PEAD, which sounds like it's a medical condition, but it's post-earnings announcement drift, right? The idea that you get some kind of earnings surprise, there's a gap, and then there's gap in price, and there historically tends to be an initial underreaction to just how good the earnings release is, despite the gap, and then there's kind of momentum, right, that persists at least in the intermediate short term. Do you tend to weight in your mind earnings surprises more heavily, and how do you factor in the magnitude of the surprise as something that could be consistent versus just a one-off?
Sure. So magnitude of surprise, I think that was a really important piece of context that you added, because I think, so under kind of going back to those sell rules, it's an underwhelming revenue versus underwhelming profit. Yeah, if they're supposed to earn maybe 50 cents a share and they earn 49 cents a share and earnings grew 38% year over year instead of 39%, that's a lot less impactful and a lot less important to me than if we had a company like Upstart, and don't mean to pick on them. I know they're a very cyclical business, but supposed to do, I don't know the exact number, but it was something along the lines of 200 million in revenue and did 80 million in revenue or something like that. And when there's that degree of miss is really when I do take that pause and stop leaning into names. But if there isn't that degree of miss, if it's very subtle and being sold off anyway, and the sell-off doesn't really make sense to me, I don't use sentiment in charts and short-term factors all that much, but I do use the 3-day rule, which is, I guess, if a company's selling off 20% in a day, just give it a few days or give it 72 hours to digest that move and that reaction. If you do want to lean in, and if I miss the bottom, if it goes up a little bit over that time, I'm fine with it. But yeah, in terms of earnings drift, that isn't a super big part of my process, but I know it's rightfully an important part of a lot of processes.
Yeah, that's more short intermediate phenomenon rather than a longer term dynamic, just as it relates to underreaction and overreaction from the studies that I've seen. Okay, let's talk about levels of conviction and weighting. Since you mentioned risk management a bit earlier, I think it's fair to say that if you have a more of a fundamental mindset, you're thinking more like a true investor, like a business owner, you can have higher conviction because you know what the underlying dynamics of the company are, and the stock price is undervalued. How much do you weight a particular position? How do you diversify? Talk to me that for a bit, because when I think fundamentals, I think high conviction.
Definitely. And there are, exactly like you said, there are varying levels of conviction in the portfolio. To me, a big piece of this decision and a big piece of position sizing at the beginning, and I do usually let positions grow from here on their own organically, but it's, are you making money? Are you profitable? Do you have free cash flow and net income? And if not, are you racing quickly towards that point? And will you be there in the very near future? And in those cases, I generally, like an Amazon or like what's another good example? Like a Match Group from earlier in the year will make it a 4, 5, 6% of a portfolio pretty quickly and let it grow from there. But if there are just pie in the sky, highly speculative bets where my mouth waters over the upside and the potential, but the ability of it being a dud and it just being a nothing and a zero is a lot higher than pretty much anything in a portfolio. And the name I think of like that's in the portfolio is Lemonade, which I know a lot of you probably think is a terrible, awful company. And time will tell if you're right. But for those companies that aren't making money, that are, I think it's 2 years away from positive adjusted EBITDA. So quickly racing in the right direction, but the margin is still has miles and miles to go. That is when I'll start the position at maybe 0.5% of the portfolio or 1% of the portfolio or 1.5%. And whether it's 0.5 or 1 or 1.5 is definitely a case by case basis. But yeah, I think just looking at my portfolio right now, the top 14 holdings are about 3/4 of my overall holdings, and there's only 20 overall. Definitely, I think a lot of people would call my portfolio somewhat concentrated. It doesn't feel that way to me, but I think a lot of people would have that opinion. And that is a large part of where that concentration is guided, what it's guided by. Now, if there's just world-class companies like Meta or like Amazon that I know they're not going anywhere, and they have one has half the planet on its apps, and the other has 40% e-commerce market share in North America. That again is when I'll lean in a little bit more aggressively at the beginning and make it a bit bigger. Just if the downside protection is a bit more compelling with just such an iconic brand like an Amazon or like a Meta.
I gotta ask you, does the stuff that you see on FinTwit drive you a little bit crazy? I have to tell you, I've used that term many times before. The level of uneducated speculation is astounding. And that's a function of ease of access through which people can trade commission free, zero DTE options, and the market environment causing a hell of a lot of overconfidence, both ways, for the bulls and the bears, because of the stair-step nature of the bears last year and the stair-step nature or melt-up, whatever you hold the bulls this year. Does anything in your soul make you say, wow, I feel like I'm in the land of the blind, the one-eyed guy is king kind of thing, just because you're actually looking at fundamentals as opposed to just doing emojis?
Yeah, maybe. I think, and I obviously I'm extremely biased, but I think the people who are interacting with me on Twitter, maybe I just do a good job of pretty aggressively blocking. But the people who are interacting with me on Twitter generally are interested in fundamentals and generally are interested in digging deeper and learning more. And there is, I mean, I can't deny it. There's so much noise on the app, and there's so much unproductive dialogue and aggressive bickering and attacking people versus attacking the idea, which just kind of drives me bonkers. But at the end of the day, I am quite grateful for Twitter. It is the top of funnel that helped me build a business, and business would not be what it is today without the app. Definitely comes with its kind of, yeah, I'll definitely come with its less, but all in all, I think I do like it here because I spend my day on here. So of course I like it here.
Yeah, but I share the same view, and I'm at the point now where just the number of followers and reach I've got, I want to just diversify my own social media reach beyond just Twitter, which I think you're also doing right with the YouTube side. But yeah, no, obviously Twitter's been, or pronounce it now that it's X, shitter, has been a big driver of attention. For those, Brad, that want to learn more about your way of looking at markets, where would you point them?
Yeah, stockmarketnerd.com. That's where I post all the newsletter content, 1,000 pages of, I like to think, very detailed and nuanced and bias limiting content and on the newsletter. It's all free. So no reason not to sign up. Go check it out.
Good place to wrap this Twitter space up. Everybody, please make sure you follow Brad Freeman here, and hopefully I'll see you all later. You're going to see how the Twitter space at around noon Eastern. Thank you, Brad. Appreciate it.
Have a great day, man.
Cheers, everybody.